Hello and welcome to another edition of Property Matters. I'm Stephen Galpin, and today we're going to be talking about the tax season for property developers and the like. And joining me to fill us in on all the detail and give us his expertise is Zee Razaq, CEO of Certax Accounting, property accounting specialist from St Albans. Welcome to you, Zee.
Thank you, Stephen. Thank you for having us, and we're going to get a lot of fun here, especially with tax season in its way right now, isn't it? It's going.
Keep it simple for me, please.
I will do my best. I will do my best.
Okay. Well, look, the first thing is generally we want to talk about how entrepreneurs are dealing with their tax self-assessments and the differences in treatment between incorporated bodies and, I suppose, private individuals. I think if I've grasped the subject properly, so I'll pass that over to you and make your start.
Stephen, really good point. And we're going to be focusing on people that are not in limited companies. So it's people buying property in their own name and traditionally partnerships. And we'll concentrate that because that's what tax season is pretty much about, the income, what the individual is earning and how it gets taxed and all the fun that goes with it. So we're going to break it into property investors predominantly. Developers are slightly different rules, but investors is quite an important part because people don't realise what they can do with the right advice and how to benefit themselves. And being a quite important part of the year, and normally in tax season, this is the focus for many people.
I think there's something fundamentally important to understand here. Forgive me for being so sort of simplistic about this, right. But there is a difference between property investment and property business income earning, isn't there? There's a difference between the two categories.
I guess what you mean by property business income is when they're in a limited company and they're extracting them.
Yeah. Well, even though as a private individual, whether you've bought for investment or whether you've bought for capital gain and development rights.
Yeah, generally the investment income is linked to obviously income tax, but then when you sell it, you're subject to capital gains tax. So normally when an investor buys, those are the two key points they're thinking about, or they should be thinking about. And what we're going to be focusing about in this is how it affects them and how can you benefit yourself? Because we love giving value, and this is what it's all about. So when we're looking at property investors, we have to then look at what strategies they've used, what type of income is it? And I'm going to try to keep it at a high level because it can get complex. So if you're a buy-to-let or HMO investor, this can be quite strenuous because of all the changes. And one of the things that I've noticed a lot of property investors, because of changes in the recent years, because of HMRC, you don't always win everything, no disrespect to HMRC, is around, for example, redeeming your mortgage. And that's quite a big cost. And right now that's happening quite a lot because people are worried about the rates increases.
That would be the fees you pay to come out of your mortgage early, yeah?
Yes. So there was case decisions made because initially HMRC used to treat it differently and they lost. So it's treated as interest cost, funny enough. And that could be quite substantial. But when you're doing it in your own name, you've got to remember that unfortunately, because it's treated as interest, because that's what the mortgage provider is giving up, and that's what you would get in charge, it's also subject to Section 24. So you have to assume there's going to be a tax credit on it. But the cost is quite big, so don't miss that in your tax returns. So that'd be huge value for the audience when they're looking at that. The other thing they've got to probably look at is how do they, I guess, account for the different income. And what I mean by that is that you have normal property rentals, which we just talked about, in your own name or joint names or in a partnership, and that's buy-to-lets, long-term lets, or HMOs. But then you've got our fund service accommodation and furnished holiday lets. And anyone who's filled in a tax return or signed it off, if someone else has done it, they have different pages. There's a reason why they've got different pages, is because they've got different treatment. And I guess I want to just differentiate so people understand. When you've got buy-to-let, it's generally done on a cash basis and it's got property pages in the self-assessment.
Okay.
Right? Furnished holiday lets and service accommodation have got separate pages, actually same page on there. And they're treated differently because they're done on an invoice basis.
So irrespective of whether you get the money or not, the liability is created by the invoice.
That's it, and the time period, yeah? We call it accrual basis in technology. But that also can benefit you because one of the things that people don't tend to use is what write-offs are allowed, right? So, for example, and this applies to both, is if I'm traveling to go and see my properties, from your home to the property and back is business mileage. So claim it. And that is currently, believe it or not, is about 45p per mile. It should be a bit higher for the first 10,000 miles if you're doing a lot, and then 25p above that. There is some other benefits if there's someone else sitting in the car who's also part of the business. So you can add an extra 5p on for that. But these are things that people don't realise, because this is cost that you have incurred that you're not reducing your taxable profit.
And over a number of years, this can build up.
And you know, I've seen so many people miss it. I can't be bothered. No, what's my tax bill so high?
Yeah.
I'm like, have you done this? Another thing is the home office cost. So running a property portfolio business, obviously you're using your home. And depending on how many hours you do, you can have preset amounts, which vary up to, I think it's 16 quid a month now. Right, so you can claim those. And I think that's quite important. And it can go up to 26 depending on how many hours you spend. So you can go on the government site and look how many hours am I spending on the business. And these are, you don't even need bills. You can claim those. Another method, there's two methods. The second method is if what you've actually incurred, right? So you can weigh up which one. Normally the first one many do because it's easy.
But I know a lot of people looked at this during the COVID crisis when they were working from home, and I think the common opinion was that it was very disappointing, the amount of money you were allowed to claim for using your own home as the place of business.
You've got to be careful, because when you're doing it as an employee, the government recently issued some guidelines, because a lot of people were using it, which they said, but they don't really want it because they're saying, look, you have to prove it, and there's a whole lot of different tests. But for property investors, because they're running a business, they have different criteria. So we've got to mix up from being an employee
I got it. Yeah.
and that. So that's quite useful. The other bit is, what else can you think about when you're actually doing it? Is the biggest area people struggle with, and it's such a huge area, is what's considered, I'm using some technical terms here, revenue expense or capital expense. What that means is, revenue is I can put it on my self-assessment. Yeah, revenue expense, it goes against my income. Capital expense is I keep it to when I sell the property. That's generally the difference between the two.
Okay, well, just hold it there for a second. So
Yeah.
when you talk about revenue expense, typically what sort of thing would that be?
So, for example, if I got a carpet here, right, this isn't the first time buying, I have to repair it or replace it because it's got damaged, and provided it's a like for like, I can claim that on my income tax.
But that would seem to me capital.
No, capital is when you first buy it,
Right.
or if you do an upgrade on it, considerable upgrade. And very important, same with kitchens and bathrooms. These are areas where people don't realise can be a huge benefit if you get the right treatment. Because you can imagine your income tax bill could reduce, because you don't know if you're ever going to sell the property.
Well, the cost of a new kitchen and bathroom these days is quite substantial. So.
It is, and that's where you need the evaluation done by your accountant, property accountant, tax advisor, because they will be able to categorise it from knowledge and experience.
Okay.
So those are quite big areas, and I see a lot of people failing on those. The other bit was that before you used to get something called wear and tear, and that they got rid of it a few years ago. Now it's what is the actual replacement cost, right? Not like I give you a percentage. It used to be 10%, I think, wear and tear allowance or something like that. Now it's not, and they got rid of it a few years ago. So if I replace what they call white goods, like a dishwasher and all this stuff, by replacing it, I can claim it. There's a section on the self-assessment. So these are really important to tag down all your expenses that you're doing, because what you're doing, you're reducing your taxable profit and therefore the tax that you pay. And I find it's just unbelievable how many people are saying, look, I'm paying too much tax.
But is it because they can't be bothered, or what is it?
It's a combination. I think they've either gone down the route that they've basically tried to do it online, either do it themselves, or they've got a general practitioner just to submit it for their behalf.
Well, interesting. That was going to be my next question to you, really. Zee, you're a well-recognised, property-related tax advisor. Let's put it that way. Okay, that's your forte. That's your specialism in business. Would people expect, and I don't mean this any disrespect to the industry, but would they expect a run-of-the-mill accountant to have your knowledge of property matters, for instance? In other words, have you got to be a little bit careful and selective where you go for your advice, not just to a accountant or a solicitor, or
Really good question. It's a difficult one because there's a lot of general practitioners that are well versed in certain subjects. They may not be with more advanced aspects where you're doing, which we're not going to get into huge detail. We've got separate shows about capital allowances. Those are very complex matters and they require good knowledge. Whereas general ones, they should be. If they're not, then you really need to look at it because it's costing you so much money right now because the cost of running the business isn't the same as what you're actually getting taxed on.
Yeah. I mean, the reason I asked the question is because across all our shows, the various shows that we do, the common thread is always build your professional team, always take professional advice. One, because it's harder to put right if you don't get it right at the beginning. And people go away and say, all right, I'll get an accountant. But I'm not quite so sure it's as simple as that because I've always had this ethos. When your accountant or your solicitor doesn't give you the right answer or the one you're hoping for, have you asked the right question? That's the
really, really good point. And I think it's depending on who you go and speak to, whether they're reactive or proactive. And everyone uses this cliche. And I'll give you an example. If you go to someone who's not familiar, they will only answer what you ask them. Yeah. If you go to someone proactive, they will give you stuff that you didn't even know that you could do. That's the difference. Yeah. And if they're doing this regularly, they're going to do it. I'll give you another example. I went to the dentist, and let's use this quick example. I used to go to General Mill dentist, and I had something wrong with my tooth, and they couldn't answer it because it was a particular problem. I went to a specialist, they gave me the answer straight away, resolved it, thank God, because it could have been not that great. Yeah. That's the same with accountants. So it depends on what you pay for and what value you're going to get. I would always look at a value-based approach. What I mean by that is, how much are they saving you? Right? How much is that then going to lead to you being able to invest more and grow your portfolio? Sure. And I think that's the way you look at it, not, oh, I'm just incurring a cost. Because it's not a cost, and it's tax deductible accountancy cost, by the way, for property entrepreneurs. And I think that the other bit I think we were going to touch is that, we've got furnished holiday lets and service accommodation. I really want to touch this area because they have different write-offs and treatments. They also have special loss treatments as well. And what I mean by that is, if I've got a general property business, right, I can only offset against other property buy-to-let. In the year, I can either offset the loss or carry it forward. I can't take it back to the previous year. Okay. I know it's a bit technical, but furnished holiday lets and service accommodations, right, they also have ring-fenced treatment as well. And I find commonly people don't understand that. They can't offset between themselves. They have to have it ring-fenced. And the furnished holiday lets have more attractive treatments around because they're considered a business. And not a non-trading business. And
what is the criteria for expressing the difference between a furnished holiday let and a buy-to-let, for instance? What's the...
But the big thing is the length of the tenancy. That's the general big driver, right? So furnished holiday let business, they tend to have, there's two bits, there's VAT aspects, but generally I say 28 or 30 days. Right. Rentals, not longer than that, over a certain period, whereas buy-to-lets, or ASTs as we call them, are 6 longer.
Months or more,
that's the hope, isn't it? But sometimes people have it only a few months, but it depends on how well you vetted them, right?
Depends how well you've served your Section 21 notice, really, doesn't it?
I know that's a big issue right now.
Sure,
but I think this is so important when you're actually doing this, because you can even see the value. And when you tot all of this up, this is how you're going to get benefit, because a lot of people don't use all of this. And therefore they're thinking, why am I getting hurt here? Yeah. The same comes to like doing the boiler, right? These are common costs that you get. A lot of people don't realise that if it's a like-for-like replacement, you can claim it, right? Even in a normal buy-to-let business, right? But if it's the first time you put the boiler in, it's a capital expense,
got you,
right? But whereas a furnished holiday let, it has capital allowances, and that's treated totally different because you can take advantage of all the fun on that. So it's making sure that you really get below the numbers, try to speak, and I would always recommend any entrepreneur who's running a property business, put everything down in your spreadsheet, whichever way you're doing your tax return, to benefit, and then get an evaluation done from them and say, look, can I claim this or not?
Okay.
I think another thing we wanted to touch, I know we're always pressed for time before we get to the second bit, is the difference between joint ownership and partnerships.
Yes.
I just want to make sure people understand this is a common fault, and we'll finish on this one, is preferable, if you can, to have property in partnership if you're husband and wife. But in order to get it a partnership, I want to use some legal terms here, right? You need to make sure the property is tenancy in common, not joint ownership. And they were like, Zee, what do you mean by that? What it means is, I've got this room here. When I've got joint, every square meter we jointly own. Yeah. Right? In tenancy common is split in half. Half is owned by someone, another. The reason why this is important is when you put it in a partnership, if the husband or the wife is a higher earner and the other one's a low earner, you can play with the numbers, and that's legitimate in the partnership. When it's joint ownership, you can't do that because it defaults to 50-50. So I'm hoping the audience get huge value and they can think about these tax planning measures.
Okay, well, there we are. We're going to go to the break. Time for you to have a cup of tea and absorb some of Zee's information that he's provided. So join us again after the break when we'll be carrying on looking at the tax situation for property investors and developers. Welcome back to Property Matters. I'm Stephen Galpin and I'm joined by Zee Razaq, who's filling us in on the vagrancies of tax returns. Now, what we're going to be talking about in part two, we've just talked about general partnerships and joint ownership. We're going to talk about the various different types of income, the types of income that you can derive from foreign ownership, and double taxation treaties. So off you go.
Do you know, we want to really touch on capital gains tax. I think that's quite a prominent area right now. Getting your ducks in a row for this can be hugely beneficial. We talk about UK capital gains tax first of all. When I sell a property that I've owned in my own name, that I've been running as a rental business, it's subject to capital gains tax. So you've got to think about what offsets that you can do to reduce that if it's gone up in value, right?
Can I just jump in there? If it's gone up in value, is there not an allowance for that upward trend?
Really good point. Used to be, they got rid of it a long time ago in your own name. It used to be called indexation.
Yes.
So what used to happen is there's a whole tables. I actually had to do one for a company recently because they've got rid of it for the company from end of 2017 as well. But you don't have that anymore. So if you get the value goes up.
And there's no alternative to that?
No, not at the moment. And that's something I think is disappointing, but it's in place now that you have to pay. The bit is, how do you benefit yourself? The planning beforehand. The key is, have you got good records? I know everyone's like, Zee, records, I hate doing those. But if you don't keep your records, and we were talking about revenue and capital expenses, the capital expenses to think about is the ones that you haven't claimed on your self-assessment, how long you've had them since the property, they're offsetable. Have you ever lived in the house as your main residence? Very important. It's also linked to something called letting relief, but that's a whole fun in itself. The other bit is any legal costs that you had when you bought it and when you're selling it, that's offsetable with your capital gains tax. Another bit is when you bought the property, you obviously pay stamp duty, land tax, right? So that is also, you can offset that. And the big one that a lot of people miss out on is, if I'd done a capital refurbishment, it's like, you know, in your office you may have claimed capital allowances, you wouldn't have done that as a buy-to-let property owner. If you've done the refurb, keep good records, because this will reduce and mitigate. And I think the last bit is, how do you split the ownership? If you're husband and wife, have you used this? Because right now you still get annual exemptions. And just doing all those things that I've just mentioned, and I've rattled through them because we've got so much to go through, but this is affected on your self-assessment. The only thing that you've got to be aware of is buy-to-let residential properties had a bit of a change in the timing on when you've got to report it now. There's two parts to it. Before you used to just put it on your self-assessment, that was sufficient. And so you had the January after the tax year you sold it. Now you have to report it within 60 days.
Of the completion of the sale?
Correct.
Right, okay.
Very, very important. Because if you don't, you're going to get a penalty. And you have to forecast what you earned in that year. So you've got to think about your income and the gain on there. And therefore you pay it obviously within 60 days.
And could that move you up a tax bracket?
It's slightly done differently because you have your income.
Yeah.
And then how much you've used of your basic rate, depending on how much you earn, is then capital gains tax on residential properties, 18 and 28% as we're speaking when we're doing this. I say that because people may watch in the future and it'd be different. But 18 is if you've still got a basic rate to use, and then 28% above when you're a higher rate taxpayer.
Okay. And it's the proportion which falls into those two categories.
Absolutely. Yeah. And you also take off the annual exemption, whatever it is, when you're doing your tax return, because it was 12,300. It will change as per the budget requirement. So this is so important for capital gains tax, and hopefully people have got a good feel for capital gains tax. Foreign capital gains tax is what you want to mention, and foreign income. So we're going to touch foreign capital gains tax and then touch foreign income after that. Foreign capital gains tax is quite a complicated area, and I want to try to
well, can I just jump in there? I mean, one of the things, again, we're fortunate here. We get a lot of questions coming in, and we get a lot of. I mean, one of the things about foreign capital gains tax, particularly in France, where there's a lot of ownership issues, they're saying now that whatever you've said in your will in the UK or whatever else, it doesn't necessarily apply so straightforwardly in France. It gets quite complicated, this business of.
I think you've raised a really good point, and I think I've said it on many episodes that I've been fortunate to be involved in, is that you can't just have one professional, i.e. say an accountancy tax advisor, that may be two professionals, or one, depending on how knowledgeable the person you're dealing with. You need a legal professional, and in this case, probably a foreign legal professional, because where people have got originate from a different area or got links to a different area in the world, you've got to have legals in both areas, and probably a tax advisor in both areas. So that goes back to the legal bit on the will. The bit from our perspective is, how do you evaluate from a capital gains tax what you've got to pay in the UK? Because every country's got different rules, right? So how it works is, first you have to get your tax advisors look, is there a double taxation treaty? Because that's number one.
Now, let's just simplify that for the viewers. So what that means is that if you pay tax in one area, you're not going to have to pay the same again in another area. That's the
potentially
broadly the treaty. Yeah?
It's what's in the written agreement between the UK and, let's say, France, for example. What is the agreement between UK and France on that particular issue, in this case capital gains tax? Have they got special rules? That's what it means, and they're very beneficial to look into, depending which country it is. If it hasn't got a double taxation treaty, it has something called unilateral relief, and I think that's what you're talking about. That's the default position when there's not a formal double taxation treaty. What that means is you pay tax in that country, and then what happens in the UK calculation, you're a bit technical here, guys, you basically assume that you sold it in the UK, and you have to do all the calculation as if it was sold in the UK.
Yeah.
And then you've got to balance what you've already paid over there.
What you've paid in France.
And then there's an offset.
Yeah.
And the bit where it gets a bit concerning is, and people always get shocked on this, is if the rate is higher over in the other country, you don't get the full relief of that country. You get it at the rate in the country that you're in, i.e. the UK. Yeah. So sometimes you may have to pay double taxation if the rate's low over there, or if it's higher, you won't get the full relief on the UK.
I just don't know how you keep up with all of this. I wouldn't have your job for all the tea in China. I really wouldn't.
Do you know what? I love it, because do you know why? You have to be passionate and the value. This can. I did one for someone from Canada. We saved them loads of money because we had to understand the double taxation treaty in that case. UK and Canada have got one, and what they've incurred, and translated to the UK. So this is a lot of fun. I also wanted to touch on is foreign income, if that's okay. The foreign income is like the income tax that you paid over there. So when people have got, and that sort of splits, I'm going to try to do it in two parts. If I've got a buy-to-let in Europe or non-Europe, I would then look at what revenue expenses out there, just like the capital gains tax, then work the calculation in the UK and work that out. The thing you've got to be careful about is, in the UK, we don't have depreciation as a tax deduction. We do have capital allowances, but not for buy-to-lets. Okay. Other countries, as I've seen, do. And that's quite beneficial in those countries. But in the UK, we've got an impact, because you may have less profit shown over there, but that's not the UK profit.
No.
Because you have to work it on UK.
The calculation's different. Yeah.
That's it. And that's where you need a bit of someone who understands this to work that out for you. Because if you don't, The ultimate is on the property investor. I think that's quite important. The other bit that you've got to be thing is furnished holiday lets. There's like 3 categories here for furnished holiday lets. I'm just trying to say furnished holiday lets. In the UK, furnished holiday lets, you've got EEA, that's the European Economic Area. You can have a furnished holiday let. Anything outside those 2, even though you may think it's a furnished holiday let, I had Canada and all that, it's considered a buy to let. And that can be huge because you don't get the tax advantages that you would get in Europe and the EEA, so such as capital allowances. So you've got to be so careful when you're doing these and get the planning. Don't leave it to January 29th and think it's going to get sorted out.
Well, I think it's the same old thing, isn't it? You know, plan your exit almost before you plan your entry.
Yeah, and I think people, do you know what happens, Stephen? A lot of times people, because it's not in a company, it's in your own name, people are like, oh, you know, I'm just going to do this on the cheap and all this. But the numbers we're talking about, especially for capital gains tax, they're quite big. So if you make that investment, it's going to pay you probably 10 times over.
Okay. Now, just quickly to finish off, one of the subjects we're always getting letters in about is withholding tax on rentals.
Really, do you know, this is one of the difficult subjects in our profession because it's not UK necessary tax, right? Because when you're a UK tax resident, that's what we're assuming, and you've got foreign income, right? Like the UK now, a lot of people in property are withholding tax, and they may not have the same kind of rules that we've got, but we've got to put that into the calculation. But the problem I think a lot of people find is, depending on how they've calculated that profit, it could make them loss making.
Yes.
And you've got to be so careful. So now you have to think, what is the UK position and the country that you've got it in? Because if you don't, you could get a pain point. And I think the other thing is the tax rates are so important. If that's got a high income tax rate in that country compared to the UK, you're not going to get the full relief. Going back to the calculations that I was telling you before, because they assume you have earned it in the UK, and then you get this either unilateral relief, or if they have got a double taxation treaty, so important.
And again, you know, it's important, isn't it, to sort of stress test your potential interest rate payments, because, you know, buy-to-let owners these days are working on much tighter margins in between their mortgage and their income. And if all of a sudden you have 20-odd% of that being withheld for whatever reason, it could just put you into a negative cash flow situation, can't it? And you're having to actually pay out to run your business.
I know the audience will thinking today we got quite deep in some technical aspects, but this is huge value. If you just, whoever's watching this goes through all the different things that we've covered and you've given the proper entrepreneurial perspective, it can be a difference maker. But really key, get the knowledge, get your list together, whatever it is, go through the list. That's what we're sort of giving you a bit of a little roadmap of things that you've got to do, and then see what can you do, get advice to mitigate it if it's UK or foreign tax advice.
Okay. Well, once again, I'm going to say a big thank you to Zee Razaq for his expertise in our programme today. Hope you've enjoyed it. I hope it's been useful to you. So Zee, thank you very much for coming in. Much appreciated. I'm Stephen Galpin. I look forward to seeing you next time on another Property Matters show.